Live from New York City this morning. Good morning, good morning. Wrapping up banking season for the big banks on Wall Street, for earnings season at least, and then on to the regionals a little bit later. Equity futures down about 6 or 0.7%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Ferro.
Live from New York, coming up, Morgan Stanley wrapping up earnings on Wall Street as Western Alliance offers some hope for the regionals. Fed officials continue to push back against rate cuts. We begin with the big issue. Is the coast clear?
The large banks had a great quarter.
I had to double check my numbers.
Very, very good.
Because the revenue beat is amazing.
The regional banks.
We're already seeing deposit inflows.
We're seeing better earnings.
I'm not, in the gloom and doom camp on this earnings season. You've got very good earnings and you've got very good numbers. We are really just baking in this very onerous 2023 earnings picture.
You've had, the benefit of interest rates moving up.
I don't think we're completely out of the woods yet.
Things have started to look a little bit better than some analysts expect.
But it was all against expectations.
We'll hear much more from some of those smaller mid-sized banks this week.
Team coverage begins right now with Bloomberg Sonali Vasek here in New York alongside Alison Williams. Alison, first to you. JP Morgan decent, better than good. Bank of America, Citi, Wells, all the same. Look at Morgan Stanley this morning, down about 4% at the pre-market. What's gone wrong there?
Well, equities trading really is much more important to Morgan Stanley than the other banks, and that was a disappointment this quarter. Actually, across the board, the banks missed on equities trading, and we saw declines except for Goldman Sachs. The offset was better than expected fix. Again, Goldman Sachs an outlier there where they missed. And fees still weak, coming in a little weaker than expected. At Morgan Stanley, the other thing is wealth flows coming in a little bit light. That's a very important business for the bank. And then deposits. That's a big focus this quarter, especially net interest income. For Morgan Stanley, it was a touch light, and we expect to see moderation. And the cost of deposits, especially for Morgan Stanley, because the wealth business does tend to be much more price sensitive, those deposits going up pretty sizably.
Alison, did James Gorman give us much of an outlook at all?
I mean, nothing beyond, I guess, what we would expect in terms of the fact that they just said on the call that net interest income is going to be moderating. Again, that's not a surprise. We expect that across the banks. You mentioned JP Morgan earlier. They really had the big blowout number in net interest income quarter, and the expectations, I think, they're moving up for everybody else. Modest beats, and in general, looking for a slowing of net interest income. The other thing that we're hearing a lot of the banks talking about is the investment banking outlook. Those fees, as I said, came in a little bit better, but they're still down 20 to 25%. They were cut in half last year. There's more and more talk about the second half seeing some kind of revival, but that's really predicated on the Fed cutting. And again, a lot of uncertainty around that.
Morgan Stanley right now down by more than 4% in the pre-market. The word that Morgan Stanley used for the investment banking division, investment banking more broadly, constrained. The word of the moment for the regionals, stability, maybe. Western Alliance, even more than that. That stock is flying in early trading. Sonali, by 22%.
Yeah, check it out. You have profit that beat estimates. You have deposits stabilizing. This was a bank that was poorly beaten in the market today. And guess what, John? It's driving up the other banks today, too, in the pre-market. If you take a look at PacWest as well, you have the stock rising pre-market. This is a bank that has not yet reported, but was recently cut to junk by Fitch. I also want to point out U.S. Bancorp, which had reported as well. This is the largest regional bank, and you are seeing deposits rise as people have flocked to safety. So stability among some of the firms that we were concerned about, as well as some gains over here at the larger end of the regional banking system. The other interesting thing about Western Alliance is surgical asset sales, whether it's Western Alliance or Goldman Sachs, are able to offload some things on their books to other people. Where those assets go is an interesting question, and whether we'll be seeing more deals like that. I want to point out some of the bad news in the market as well. We have Ally Financial down a bit as profit missed estimates. Remember, Americans are falling behind on car payments at the fastest rate since 2009. And this is a steady reminder here that not only is net interest income under pressure, but also certain parts of the loan market are really starting to show some real real cracks. Now, how long those cracks show for is the question. According to James Gorman, this is not a banking crisis. That doesn't mean the banks aren't experiencing some significant worries. But again, he says to expect some volatility ahead for the coming months as the market works its way through this stuff.
Hey, Shanali, wonderful work as always, alongside Alison Williams. To the two of you, thank you. Joining us now, I'm pleased to say, Subhadra Rajappa, Gersten Distenfeld, Subhadra Rajappa of SocGen, Gersten, of course, of AllianceBernstein. Guys, I want to start with this quote from Citi, if I can, with one question in mind. Was the events of the last month a one-off event that we can just leave behind, or the beginning of a process? And this is what Andrews had to say consistently over at Citi. He said this last week. The stresses we're seeing in the banking system, rapidly contained, they've now faded. If the labour market stays resilient and inflation stays persistent, as they do in our forecast, the Fed is likely to hike not only in May, but again in June and July. Risks are two-sided, but we maintain our modal expectation for a terminal policy range of 550 to 575. So let's start with that question, Subhadra. Do you think the events of the last month are a one-off that we can leave behind, or the beginning of a process that leads to tighter financial conditions, tighter lending standards?
I think this is definitely the beginning of a process, right? This is exactly what you should expect at the end of the cycle. As the Fed raises rates aggressively, something breaks. Yes, the regional banking crisis has definitely meaningfully abated. You're seeing deposit outflows start to stabilize a little bit. You're also seeing bank earnings, where less bad news is good. And broadly speaking, we can look past the last month and a half of events, but we're always looking towards what the next shoe to drop will be. I mean, you're looking at mortgage rates starting to be at nearly the highest level in nearly 2 months. The commercial real estate sector is still, having issues and could have issues going forward. So we're just watching to see what else could potentially come under pressure. Also, credit conditions, broadly speaking, are tightening because regional banks, even though they're stable, might not be making as many loans. C&I loans are going to decline. So we're looking towards what the ramifications will be for tighter credit conditions on the broader markets.
Gersten, how would you frame things right now?
Well, I think the answer to your question, John, initially is both. I think they're both idiosyncratic in that there are reasons SVB, CS, banks in general. I think Subhadra just said, when the Fed raises rates, things break. But I think the answer is also that it's just a continuation of the real pickle the Fed is in here. If we're going to see tighter lending standards, more banking turmoil, right, that requires lower rates and more liquidity. And fighting inflation, which is still too high, requires the exact opposite. So the Fed's in a real bind, and it's not just the banking sector. We know that Fed policy acts with a lag. We're going to be seeing slower growth. We're going to be seeing weakness. And the question on the table, and everyone's trying to predict exactly what the Fed's going to do. The Fed's not sure what they're going to do here because they're in a real bind.
Right now, this bond market's somewhere in between. So if you take the high and the low of the last month or so, the last 6 weeks, you go pre-SVB, the high on the 2-year pre-SVB north of 5%, the low post-SVB was in the 350s, and right now we're somewhere in between around 420, 430. And Subhadra, we've got a decision to make. Either we go back to pre-SVB or we dance around these levels and start moving lower. I noticed from your notes, your research, Subhadra, you think the market pricing of rate cuts seems a bit premature, but ultimately you have a bias towards lower yields still. Is that right?
Yes. I mean, our bias for yields for this year is gradual decline in yields. We still feel like 10-year yields have sort of peaked around 4%. The run-up in yields last month reflected a very aggressive policy path. Now we seem to be coalescing again towards the 5 to 5.25% as being the terminal Fed funds rate, which is really where we had it penciled in. And for rates to remain stable for the remainder of the year. That's really where I see the dichotomy between our views and the market, because the market's starting to price in cuts as early as, I'd say, November of this year. So I think in an environment where the labor market's relatively strong and inflation is sticky, the Fed is probably going to keep policy stable for the remainder of the year, not deliver cuts unless we see some sort of a financial stability issue like we saw earlier on this year, or if there's a meaningful slowdown and inflation is actually starting to come down meaningfully, and then that requires a little bit of an adjustment in the policy path. But as of now, I feel like the market's prematurely pricing in for cuts in the second half of this year.
Well, right now, Gershon, at the moment, we're talking up recession prospects and rate cuts. At the same time, we're seeing tighter spreads in the credit market. Gershon, you've been out front about how strong, resilient you think parts of credit actually are. I just wonder where you are now on high yield credit.
Not much of a change. I mean, the daily gyrations in the market don't really impact things all that much. I think the starting point matters. Our credit conditions, our credit metrics are going to get worse over the next few months. Yeah, probably. Our default's going to go up, yes. But a lot of that is priced in already. And the real dichotomy between the markets is between the equity markets and the credit market. You know, the VIX dipped below 17. If it was yesterday or the day before. High yield spreads should be a lot tighter given that. The equity markets are, again, saying that things are much clearer. But, John, if I could just jump back for 1 second,
sure.
This idea of what's priced into markets. It's a pet peeve of mine. We say the market's pricing in something for two reasons. One is 18 months ago, the market was pricing in like 1 or 2 hikes, and we've had like a zillion. But more to the point, when we say that we're pricing in 2 to 3 cuts right now, that is really not accurate. What I think the market is telling you is that base case, call it 80% plus, the Fed's going to keep rates high for a long time and is not going to cut. But there's this, call it 15, 20% probability that things just get really, really bad and the Fed's going to have to cut 200-300 basis points. This 2-3 cuts is really an average of very different scenarios that could play out, and no one really knows, including the Fed.
So Neil Dutcher of Renmac has said the same thing, Gershon. I think you make a very valid point. He's basically saying there's no in-between. And there is no in-between in reality. They're either going to have to cut and cut a lot or not cut at all. Is Gershon that essentially what you have to say on this matter? Yeah, that's exactly the case. I mean, look, there's not zero probability they just cut a little bit. But yeah, it's these forces that we're talking about. The difference in what the bond market and the equity market is saying, the tension between growth and inflation. We're going to have to see how that plays out. And yes, the Fed has been very clear. They don't want to repeat the 1970s. They don't want to cut too early. But at some point, the damage could be so great that they're going to have to cut and cut hard. So, Badger, final word on that, please.
I completely agree with Gershon. The market's pricing in a probability, not just of one scenario, but a variety of scenarios. And the tails are quite different between the Fed, hiking perhaps more than what the market's expecting, as well as cutting a lot more than what the market's expecting. If you look at past rate cut cycles, if for some reason the recession window gets pulled in forward, the Fed's not going to be cutting by 25 basis points. They're going to be cutting a little bit more aggressively if inflation starts to come down. So that's distribution of probabilities is what the market's pricing in. So I completely agree with Gershon. You shouldn't be reading too much into the market pricing of hikes or cuts. Or to Fed projections for that matter as well. We talk a lot about the median dot and one more rate hike. I just pulled up the range in the SCP. The range for next year from Fed members, Fed officials, is anywhere from 3.4% to 5.6%. Which kind of speaks to what you guys are talking about right now. So, Badger, Gershon, you're going to be sticking with us. Going into the opening bell, about 18 minutes away. Equity futures are negative by 0.5%. Abby has some of the movers for you. Hey, Abby.
Hey, John. Well, we have a real divergence here between the big banks and the regional banks, one that we haven't seen for quite some time. Specifically, Morgan Stanley is lower. This, of course, after on the surface, the quarter looks okay, but credit losses surging and profits declining on a year-over-year basis. Western Alliance absolutely surging. Balance sheet relief. Deposits rose $2 billion this month through April 14th. So those crisis fears cooling. As for Netflix, shares are lower, but well off the post-market lows. Subscribers miss coming in below 2 million. The outlook is light, but investors encouraged by passwords. Tesla prices are going down again. And then to round out the risk-off outlook, John, Riot Platforms and blockchain crypto, that space is lower, perhaps suggesting again that the risk tone today not so great.
Abby, thank you. Futures lower too by 0.5% on the S&P. Coming up, gearing up for more layoffs.
The last shoe to drop really is the jobs market and the unemployment picture. And you would expect as the recession really starts to bite, that's when the layoffs start to happen.
More on that still ahead.
We've got negative GDP growth in the second half of the year, a recession. And so, of course, alongside that, we'd expect to see negative payroll prints. We've got the unemployment rate rising a bit, like over a percentage point, getting to over 4.5 by the end of the year. So we do expect that you will see the strength of the labor market taper as the overall economy really begins to slow.
Corporations across America have made the announcements. Now they're starting to make the cuts. Meta is set to begin company-wide layoffs today. In a memo seen by Bloomberg, teams from Facebook, WhatsApp, Instagram and Reality Labs are set to shrink, followed by another round of cuts in May. Disney also given the green light. The company's set to shed thousands of jobs as early as next week, with its entertainment division alone looking at a 15% reduction. In the end, the cost-cutting push from Meta and Disney will slash a total of 17,000 jobs. Mike McKee has more. Morning, Mike.
Good morning, John. Well, as Michelle Girard said, we are looking for signs of recession in all of these job cut announcements and all of these job cuts. And in a way, they're a little worse than you anticipated, because while Meta is cutting 10,000 jobs now, they already cut 11,000 in November. And as you pointed out, it's across the board. Disney losing up to 7,000 jobs across the board. Now, why is this happening? Is it because the Fed has tightened interest rates? Is it because we're seeing the economy slow down? It's kind of hard to tell at this point. You can see here the number of companies that have laid off people, and that's not quite showing up in all the data yet. Take a look at what's going on with Meta. Their number of employees has risen steadily, but all of a sudden, advertising revenue dropping off there. Are they cutting, and that red line is where they're going to cut to, are they cutting jobs because they're not getting the revenue? Or because they're preparing for a recession, or is it a little bit of both? That's the question that'll be before the Fed. If you don't work at Meta or Disney, you're probably more concerned with what Fed interest rates are going to do. And jobless claims are still very low, even though they've gone up. Unemployment at 3.5%. One reason is laid off employees can't get benefits if they're getting severance. They also get 60 days notice of a layoff. Now, those are starting to expire, and we're starting to see these layoffs. But there's still a lot of open jobs. You look at leisure and hospitality. This isn't going to help the people at Meta, but they're still 2% below where they were before the pandemic. So there are jobs out there. The Fed thinks people can get new jobs. Is it going to lead us to recession or higher interest rates?
Mike, can I just ask you about claims just briefly?
Yeah.
We started to see that break out a little bit recently. How do you explain that?
The biggest thing was they changed the seasonal adjustment factors that moved it up. We've seen in the last couple of weeks some slight moves beyond the seasonal adjustment changes. The question is, does that continue, and does it start to accelerate? Because a lot of these people who were getting severance are going to fall out of that, and then they will be eligible for benefits. That's the question for the markets, and we'll be here at 8:30 tomorrow to get the jobless claims numbers for you.
I look forward to covering that with you, Mike. Thank you, as always, Mike McKee. So, Badger, I want to come back to you on Fed forecasts, market pricing. We were talking about rates. Can we talk about unemployment too? So they've got this very smooth path, kind of jump up to 4.5% unemployment, and then you stay there, 4.6, 4.6 over the next couple of years. Can I just ask you what you think about that projection from the Fed for unemployment?
Well, one, they might not have as much visibility into the employment picture several years into their forecasts. And second of all, I mean, the SEP is always tricky because they don't really want to, they won't be able to really show any sort of a dire scenario, because policy is supposed to adjust to account for any sort of displacements in the job market. I mean, price stability is part of their mandate. So the forecasts are not really going to reflect a very sharp rise in the unemployment rate, so to say. Our view on employment, broadly speaking, is that it might not, the unemployment rate might not go up to 4.5% by the end of the year, which is what the Fed has forecast. The labor market is still extraordinarily strong. The layoffs are very much in the tech sector. The tech sector is not the majority of the job market, and like Mike pointed out, the services sector is still trying to add jobs, and there's not enough people that they can find. So broadly speaking, to us, the labor market's probably a lot more robust than what the Fed has penciled in for the end of this year.
So where does that leave the equity market? Equity futures right now down 0.6%. All this talk of recession, this old phrase that gets thrown around on Wall Street, equity markets bottom before the end of a recession, not before the start of one. Marko Kolanovic of JP Morgan pushing that one forward again earlier this week. How does the credit market typically respond to things like this, Gershon? We're often told that credit leads, the spreads widen, going to economic difficulty. And as you've pointed out, spreads have been tightening.
I think credit markets are just behaving very differently this time, but for good reason. This will be, I hate to use the word recession, John. If we're going into a recession, a downturn, this will be the first time on record of like 50 years of data that we have, where in the preceding couple of years, companies did not take leveraging transactions. They didn't buy back a lot of shares, didn't make acquisitions, didn't ramp up capital expenditures. They were actually terming out debt and paying down debt. And it's not because companies have gotten religion on how to operate better. It's very simply we had COVID. And it's hard to remember now, but 3 years ago, we were sitting here saying the markets could have another 2008 outcome. So companies took that approach. They were very, very conservative. So you're looking at a much higher credit quality market. You look at the high yield market today, versus 5-7 years ago, many, many more double Bs, many fewer triple Cs. So just looking at raw spreads doesn't tell you the whole story.
It's different this time, Gershon? Are you basically saying it's different this time?
You know me, John. I'll never say it's different this time. There's a lot of similarities, but there are differences that we need to take into account. And you can't, something as complex as the overall credit markets and rate markets and equity markets, it's very hard to distill it down to just simple talking points around that. To me, the much bigger anomaly today is in the equity markets. As I think I said when I was on last time, just the risk-free rate alone, the 30-year going from roughly 1.8 to 3.8 should have caused the equity markets to be down 30%. And they've been down far less. Now, again, I'm not predicting equity markets are going to suffer here, but equities are saying things are a lot calmer than the credit markets. I think that's what we need to focus on.
Hey, Gershon, I'll focus on that right now. Great to catch up with you, sir, as always. Alongside Subhadra Rajappa, to the two of you, thank you. Your equity market down 0.6%. Coming up the morning calls and later, back to the equity market. Big bank earnings coming to a close. We'll get the scorecard from Ken Leon at CFRA and why TPW's Jay Pawlowski is staying bullish on some of these names. That conversation just around the corner. 5 minutes away from the opening bell. Equity futures down about 0.5%. Let's get you some morning calls. First up, UBS upgrading ExxonMobil to a buy, saying the company is best positioned to outperform given its improving balance sheet. The stock's down 0.8%. Gordon Haskett upgrading Walmart to buy, expecting the retailer to benefit from a softening macro environment. And finally, RBC downgrading Rivian to sector perform, seeing limited catalysts and growing risk to margins. We're down there by 2.4%. Coming up, the big banks wrapping up earnings season as big tech gets underway. We're breaking down the results with CFRA's Ken Leon and TPW's Jay Pawlowski. Equity futures down about 0.5%. Your opening bell up next. Coming into Wednesday with the equity market on the S&P 500 close to the highest since early February. Futures backing away just a little bit. We're down 0.5% on the S&P 500. We're down about 0.8% on the Nasdaq. Some weakness in the Nasdaq with the bond market repricing once again. Yields up. There's the opening bell. Switch at the board and get to the bond market. Yields up and away by 3 basis points on a 10-year, 360.61 on a 2-year. Front end of the curve very close to 430. A little bit earlier on in the session. Your 2-year right now yields higher by 4 basis points. Let's call this 424. Off the back of that, just a touch of dollar strength. Euro dollar negative by 0.1%, 109.55. And crude a break of 80, 79.60. We're down by 1.6%. 20 seconds into the session, your equity market shaping up as follows. close, we are negative by 0.5% on the S&P. On a broader NASDAQ, we're down by about 0.75%. One stock to watch at the open is Netflix, falling after reporting disappointing subscriber growth. This is the company prepares to crack down on shared accounts in the United States. Abby potentially giving the company a lift later this year.
Yeah, indeed. And it's been a bit of a wild ride because in after hours yesterday, the stock had been down about as much as 12%, but now down far less than that. And I think it has a lot to do with that expectation that we could see growth on that prototype, those 4 countries in Latin America where they are, in fact, requiring paid sharing for the streaming services. So the idea that that's going to help in the future. But right now, relative to why the stock is down and why it had absolutely plunged, it has everything to do with subscriber growth. The last quarter that they reported, light right across the board, the outlook a little light. And you can see that subscribers going in the wrong direction out of the pandemic peak, again, missing, coming in at 1.75 million for the first quarter. The estimate had been for above 2 million. The stock is up, though, in a big way out of its bottom from last year. In fact, it's a double. It's been a wild ride for this stock. And that really reflects, I believe, John, what you were talking about, those growth expectations, that if they do put in the paid sharing aspect, that could really boost growth for the company later this year. Another thing that they talked about, I'm very sad about, their legacy disc business is going away, but that could, in fact, also boost growth if some of the people who use disc do, in fact, subscribe as streamers, John.
I had no idea the service still existed. I had no idea people still used it. Abby, thank you. DVDs, still. UBS like what they see in the results. Netflix say this, or rather UBS says this about Netflix. We see Netflix as the main beneficiary of easing competition. This will drive upside to subscribers and pricing power, while also keeping a lid on content costs. We expect growth to inflect in Q3 and beyond. That stock down by about 3.8%. Another name we need to talk about, Tesla. Cutting prices again in the US. It's the second time this month, with quarterly results coming after the closing bell. I want to get to David Welch for more. David, the stock's down by about 3%. We're doing it again. And I've lost count, David, how many times this has happened this year.
Look, this is the second price cut just this month, and prices were, last time you and I talked about this, John, it was cumulative price cuts of over 20% for all of the models. Now, they do have 25% gross margins, and that's why they've been able to do this, to basically keep total profits up by ramping up volume even if margins get lower. But that can't happen forever. They keep cutting these prices. And remember, this is also the quarter that they are ramping up production of the Gigafactory in Austin. So they've got more production coming online. They've got to sell that. They've had disappointing numbers both for the older Model S and Model X, and sales numbers overall. And also the last time they reported sales, they built more than they actually delivered. So there's some softness there. I mean, Tesla's still overall a growth company compared to last year, but it's not the meteoric growth company that it once was, and I think they're just giving margin away to keep all of their plants busy at this point.
David, you and I are going to talk about this name again tomorrow when we get earnings a little bit later. That stock is down by 3% this morning, at least. Year to date, still flying year to date. Had a pretty decent year so far relative to the pain it's gone through over the last couple of years, the last 12 months particularly. I want to talk about financials and Morgan Stanley wrapping up big bank earnings with a trading miss. The CEO, James Gorman, saying this: the firm delivered strong results in a very unusual environment, demonstrating the strength of our business model. Equity and fixed income revenues were strong, although investment banking activity continues to be constrained. Now, Katie, what they say is strong, other people just call a miss.
Oh, big time. I mean, if you really parse through these numbers and look at what's moving the stock, it seems to be what was a huge drop in net income. That measure dropped 20% from a year earlier, coming in at about $2.84 billion. That was even though you saw a narrow beat in both trading and the banking segments. And it's really overshadowing what was very good news from its wealth unit that beat first quarter expectations. But you take a look at shares down 2.4% as trading kicks off. And that drop in net income, it stands out in a bad way, John. As you can see, if you look at all the other big banks, they reported a rebound in that measure, leading to the highest cumulative net income haul in at least over a year. JP Morgan in particular brought in about $2.9 billion. So Morgan Stanley definitely the odd one out here.
Stock down 2.4%. Katie, thank you, as always. I think it speaks volumes about the moment we're in, that our chief Wall Street correspondent is not talking about Goldman, Morgan Stanley, Bank of America, Citi Wells or JP Morgan. Shonali Bassett's going to talk about Western Alliance, which is up by about 17% this morning. Shonali, this is where the focus is.
Man, can you believe it? And what's interesting here is not only deposits stabilizing, drawing in more at the beginning of April, really pushing aside some of the fears the market has had, but the idea of some asset sales that shored up its balance sheet even further. So you're finding some relief for the regional banks in the market. Just take a look at all that green on the screen. You have a Western Alliance, of course, up as much as it is. Citizens had also reported, and while deposits are stabilized there as well, you do have them cutting the net interest income guidance. John, I'm a lot like you in this fashion. I don't believe the trading at first when I see it sometimes, because as the market bakes in these pressures on profitability, how does the story change? Now, again, these stocks have sold off very significantly as well. It's not all a deposit story at the end of the day. But, you know, if you think about it, we have a lot more ahead of us. Tomorrow is actually the bulk of the earnings day when you look at the banks ahead of us. East West Bancorp, Comerica, KeyCorp, Truist, Huntington, Fifth Third. Today, after the market, you have Zions Bank. Zions is very heavily exposed to commercial real estate. You had Morgan Stanley, Wells Fargo already warning on commercial real estate as it stands. You had Ally really down today because of the auto sector. So I think once we get past the bulk of the stabilization story, then you start looking to the loan story and the individual pockets of the market that are facing pressures.
Shonali, first is about surviving, and then it comes back to profitability. Looking forward to the conversation tomorrow. Also had one eye on First Republic reporting Monday. That's going to be a big one to watch too. The broader equity market on the S&P 500 a little bit lighter, softer, lower this morning. We're down by about 0.4%. Joining us now to discuss the banking sector, CFRA's Ken Leon. Ken, wonderful to catch up with you, sir. As always, some of the big banks have dominated. We know that, Ken. The small ones, are they recovering? Have they recovered from what you've seen so far, Ken?
The landscape changes and the narrative is focused more on traditional lending and deposits plus risk to commercial real estate. So as you move downstream to the smaller banks, these are going to get the attention of analysts on the street. The larger banks, it's essentially, we just have very weak markets, both for trading, equity and fixed income, plus all areas of investment banking. Surprisingly, and the tone on Bloomberg has been kind of critical of Morgan Stanley, but I like where we are, mostly because as we go to the second half of this year and next year, there's a great opportunity for gaining wallet share in investment banking and also a rebound in trading. The wallet share will come from Credit Suisse out of the market. Morgan Stanley's weakest geography was Europe. It was down 25%. Everywhere else was like down slightly. So you put it together, Morgan Stanley with a 3.5% yield, as Tom Keene says, a 17% return on equity, and its worst quarter probably in the last 6 or 8 quarters. And you're really in a trajectory opportunity for the second half when the Fed stops raising rates. We move a little bit away from a risk off to a slightly risk on environment into next year. Morgan Stanley looks really good here, and that's why we have a strong buy.
You like that name, Ken. You also like Bank of America, buy. Citi, buy. JP Morgan, buy. Where did the positives come from for those names later this year?
Well, it gets back to your first question. The middle of March, we went from hold to strong buy on Goldman and Morgan Stanley because they didn't have the risk that we saw in the banking crisis, and they're less dependent on net interest income. For the Bank of America and even JP Morgan, they will quietly gain market share in every local market as we see more business flowing their way, both from consumer and small business. The real wild card here, and this is a conversation maybe a month from now, is really what is regulation in the post-crisis that we saw? What will that mean for all of the banks, but in particularly for the large banks in terms of whether they may need to keep higher regulated capital, which may kind of handcuff future dividend growth and share buyback. To me, that's the biggest risk, John, to the biggest banks.
They look more and more like utilities with that in mind. Ken, thank you, as always, for making some time for us on what I know is a really busy morning for you, Ken. We're going to be talking about that, no doubt, before next month. We'll talk about that over the next couple of weeks. TPW's Jay Pawlowski making the case for stocks writing this. We expect to see equities break up and out of their range, with the next Fed decision serving as a catalyst. Jay Pawlowski joins us right now. Jay, wonderful to hear from you, buddy. As always, you have been and remain bullish the banks through all of this, Jay. And right now it seems to be paying off. Jay, just walk me through why.
Well, John, I think we have what we've been calling a curtain of FUD, or fear, uncertainty, and doubt across the market. Let me just give you a couple of examples. You know, the smart money example is the hedge funds are the most short the S&P that they've been since 2011. The broad institutional market, the B of A fund manager survey, longest period of extreme pessimism in the history of that report. The public, that other network reports that the public in the U.S. has never been more negative on the current and future outlook of the economy. And then the policymaking community, the World Bank and IMF meetings last week. I have a friend who's attended for 30 years, called me from D.C. and said he's never seen such negative sentiment. So you have this tremendous negativity out there, which is not matched at all by the economic environment, which is growth of 2%, not matched at all by the earnings outlook for companies coming in, again, Q1 here, better than expected. And I think to the point of the quote you referenced, looking for a situation where you have earnings, you have the sell-side equity analysts forecasting accelerating earnings in the second half of the year, versus the fixed income investor community expecting a recession and rate cuts. One of those two is going to be wrong. We think it's the fixed income outlook is going to be wrong. The Fed meeting, the Fed is going to go on hold, and that is going to catalyze this break out of the trading range that we've been in really almost a year now, John. For 240 days and counting, the S&P has been around 4,000. We're testing the upside of that range, 4,200. We think the Fed meeting is going to serve as the catalyst to break up and out rather than down.
Jay, I wonder where that leaves the bond market then, because you mentioned the IMF. I was there too. Incredibly gloomy, really, really downbeat. They put out that blog piece, that post, that report, call it what you will, about pre-pandemic interest rates making a comeback. Jay, what did you make of that?
They're just completely wrong, John. I mean, look, completely wrong. And you know, the history of these gatherings is you take the opposite of the consensus, right? It's the same with the Davos crowd. You take the other side. It reminds me of the famous quote from Bernard Baruch. The main purpose of the stock market is to make fools of as many people as possible. And that's what's going on. You have all these people talking about going to cash. Well, guess what? In March, with the SVB and Credit Suisse failures, cash was one of the worst performing assets. Way underperformed equity, underperformed high yield, et cetera. So we think the fixed income market is not attractive. We've been underweight fixed income for the last year or so, and that hurt us, you know, obviously when rates tumbled there for a little bit, but now they've bounced back, and we see that middle path, John, that you and I have talked about for a year.
Yeah.
High nominal growth world, and that's what people continue to miss, even with the earnings. With the U.S. having nominal growth of 6 or 7%. It's no surprise that sales are growing at 8 to 10%, and earnings are going to be okay. And as we get through this period and go forward, as your prior guest just said, we look into 24, even the most bearish of people are bullish on 2024. So time is running out for the bears. We're getting to that crunch point. We think it's going to be the Fed meeting. It's going to go on hold. That's going to open up the rest of the world as the dollar weakens. And as you know, we have a bias and have had a bias
yep.
to the non-U.S. markets. Continue to believe that's where we want to be.
Jay, you know markets can be brutal. You talked about making a fool of people. If you want to make a fool of people these days, ask for a forecast and just wait 5 minutes, because this world changes so quickly. I've gone through this a few times with you, Jay. I remember January, soft landing. February, no landing. Then it was March, hard landing. April, we've still got to conclude what April's about. Jay, if you believe we remain in this high nominal growth world, I just wonder why you also believe the Fed can pause in that world.
Yeah, because I think we're having a situation where inflation is decelerating, John, and we're going to get to lower inflation. We clearly are on the path to that. We know that the second half inflation numbers are going to be benign because the shelter component is going to collapse, as we know from real-time evidence. And look, I think the FUD curtain is obscuring some major global policy positives that people are just missing because they're so focused on the crisis du jour, as you pointed out. Let me give you two or three. One is, the most important, is the return of industrial policy to the U.S. This hasn't happened in 70 years, and the combination of the CHIPS Act, the Infrastructure Act, and the Inflation Reduction Act means that we have, for the first time in 70 years, since the 50s, public and private spending, which is leading to things like non-residential construction running up 20% year over year. So when you wonder why the housing collapse did not lead to big unemployment in construction, it's because all those folks are working in non-residential factory construction to deal with semiconductor fab plants, electric vehicle, battery plants, all coming into the United States. So that's a major one.
Yep.
And then you have in Japan, you have yield curve control going away. In China, you have domestic demand-driven growth as opposed to fixed asset growth. And in the U.S. and globally, I expect that we're going to see central banks accept and validate the high nominal growth world with an inflation target that's not going to be 2%. Again, we've talked about it. 2%, purely arbitrary, only been the number for a decade. We think the Fed and others are going to kind of not declare victory, not come out and say in a big press release, oh, we're changing our inflation target. They're just going to let inflation sit around 3%.
Tolerate it.
And validate the nominal growth world.
Yeah, you're not the only one thinking that, Jay. Others too. Jay, thank you, sir, as always, on the curtain of FUD, fear, uncertainty and doubt. Your equity markets, 16 minutes into the session, we're down about 0.5%. Up next, Secretary Yellen set to address economic ties with China.
The historic investment that the president has already made, they'll put the United States on a path to outcompete China. You hear us talk about that often, for jobs and investments, building the future of transportation.
That conversation next.
This is Bloomberg's The Open. I'm Lisa Mateo, live in the principal room. Coming up, Nathan Blecharczyk, co-founder of Airbnb. That conversation at 12:30 p.m. Eastern, 5:30 p.m. in London. This is Bloomberg.
The historic investment that the president has already made has secured to build more electric cars here in America. They'll put the United States on a path to outcompete China. You hear us talk about that often, for jobs and investments, building the future of transportation. This is what we think it's going to deliver for the American people.
This is one to watch. Secretary Yellen delivering remarks on US-China economic ties tomorrow. The Treasury writing in a statement her speech will, quote, underscore that in its bilateral relationship with China, the US proceeds with confidence about the enduring fundamental strength of our economy. This is G7 ministers a call for greater engagement with China on global issues. AMH joins us now down in Washington. Morning, Anne-Marie.
Good morning, John. As you said, this is definitely one to watch. It's Secretary Yellen's most extensive speech to date on U.S.-China economic policy. And what she's going to want to outline is, of course, U.S. national interests at play, especially security interests, as well as making sure there's a level playing field when it comes to Beijing. That is really a nod to, obviously, Chinese subsidies going to Chinese companies and also intellectual property rights. But then there's going to also be a lane where potentially Beijing and Washington could collaborate. And for this administration, it's going to be climate change as well as debt distress. But the timing of this speech, Jonathan, is so interesting. You were here in Washington, D.C. last week, and the IMF talked about fragmentation, a.k.a. two polar worlds between the United States and China, and how that could weigh down global growth. It also comes at a time as the U.S. really wants to line up partners. They want a multilateral approach to confronting Beijing. That means getting European allies like France on board. And Emmanuel Macron just left China saying he does not want to see a decouple from Beijing.
Politics. Secretary Yellen, not exactly the greatest politician, fantastic labour market expert who we all respect. Is this going to be a Treasury Secretary that takes on a bigger role in a way she hasn't before to frame the politics around this issue?
Well, I think for her, she's going to want to stay what she's comfortable with, right? So she's going to want to talk about and really lean into the economics surrounding this relationship. She's not going to want to touch things like the spy balloon or the Taiwan Strait, issues that have really derailed some of the communications we were expecting to see from this administration to Beijing. Remember, she recently sat down in Zurich with Liu He, and they talked about her attending China in the spring. Now, those plans are in the works, but they aren't finalized yet. So this is really the warm-up act before she makes that trip to Beijing, Jonathan.
MH, you and I are going to talk about this tomorrow. Looking forward to that address from the Treasury Secretary, Janet Yellen. About 23 minutes into the session, equities negative by 0.5% on the S&P. On the Nasdaq, we're down about 0.6%. Coming up next, your trading diary. After 2 days of gains on the S&P 500, we back away just a little bit, about 25 minutes into the session. We're down about 0.5% on the S&P. As yields back up again, the Nasdaq backs down by 0.6%. That is the story in the market. Let's get to the trading diary for you just briefly. The Fed's beige book coming out at 2 Eastern time, plus Fed speak continues with Goolsby and Williams, Tesla and Zions Bancorp reporting results after the closing bout. Another round of claims on Thursday and more Fed speak. Waller, Mester, Bauman, Bostic, Harker, and finally we round out the weeks with US PMIs coming up on Friday. From New York City, that rounds out the morning for me. Thank you for choosing Bloomberg TV and good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.